Let's go deeper into this one, because it's the kind of question where the examiners slip in red flags that look scarier than they actually are. The question is asking about a continuance evaluation. That's the stage where the engagement partner and the firm step back and say, do we really want to keep this client? Do we have the ability to perform a quality audit here? Now, the facts in the scenario. Aggressive earnings targets tied to bonuses. That's a fraud risk factor. There's pressure on management to meet numbers, which can tempt them to bend or break accounting rules. Complex year-end transactions. That's an inherent risk factor. Complicated deals at year-end are a classic place where material misstatements can hide. Pressure on fees and timing from the audit committee. That's an engagement risk factor. If the client wants a cheap and fast audit, it may undermine quality if the firm doesn't push back. None of these automatically impair independence. Independence is impaired by financial interests, family relationships, or assuming management's role. These are risks, not deal breakers. So option A, decline immediately, is overkill. On the other hand, brushing it off as normal business pressures, option B, is way too casual. Sure, every client has some pressures, but when you see all three together, big earnings goals, complex transactions, and audit committee pressure, that's not something to ignore. That's exactly when I need to sharpen my professional skepticism. Option D, accept only if the client agrees to a fee increase, sounds like it's addressing one of the issues, but it's a one-dimensional fix. Even if the client pays more, that doesn't solve the earnings pressure culture or the complexity of the transactions. Money alone doesn't neutralize fraud risk. Which leaves option C, reassess risk, engagement resources, and the firm's quality management responses before acceptance/continuance. This is exactly what the standards require. Before saying yes to continuing, I'd need to evaluate whether my firm has the right people with the right expertise to handle those complex year-end transactions. Assess whether we can allocate enough time and resources to do the audit properly, especially with the client pushing for speed and lower fees. Consider whether the firm's quality management system has safeguards in place, like extra partner review or consultation, to deal with these red flags. The whole idea is that continuance isn't a rubber-stamp decision. It's a deliberate evaluation of whether the risks can be managed while still performing a quality audit. If the answer is yes, we continue, but only after adjusting our plan. If the answer is no, then we withdraw. Think of it like being a pilot about to take off. If you see storm clouds ahead, you don't just cancel the flight immediately, and you don't just say, clouds are normal. You check whether your plane has the fuel, the crew, and the instruments to fly safely through. That's the auditor's responsibility here. So the correct answer is C. Reassess risk, engagement resources, and the firm's quality management responses before acceptance/continuance. All right. Let's really open this one up and connect it to the latest AICPA standards, because this is a favorite exam topic. The question is, which statement set correctly distinguishes audit, review, and compilation engagements under AICPA standards? 1. A review provides limited assurance, a compilation provides no assurance. 2. Independence is required for a review and compilation. First, let's step back and recall the three engagement types. An audit is the highest level of assurance a CPA provides on financial statements. I perform detailed procedures, including risk assessment, tests of controls, and substantive procedures. At the end, I issue an opinion that the statements are fairly presented in accordance with GAAP or another framework. This is reasonable assurance, not absolute, but it's as high as it gets. A review is governed by SSARs, Statements on Standards for Accounting and Review Services. It's less in scope than an audit. I don't test controls or dig into source documents. Instead, I use mainly inquiry and analytical procedures. The result is limited assurance. I say, based on my review, I'm not aware of any material modifications that should be made. Limited means I've done some work and given users some comfort, but not a full-blown opinion. A compilation is the lowest level. Here, I take management's financial data and put it into financial statement form.
I don't perform audit or review procedures, and I don't give any assurance. My job is basically to organize and present. The compilation report makes it clear that I did not audit or review, and therefore provide no assurance. Now let's tackle the statements. Statement 1. A review provides limited assurance, a compilation provides no assurance. That is correct. The distinction is baked right into SRs. Limited assurance belongs to review engagements, while compilations provide none. This is a bedrock fact tested again and again.
Statement 2. Independence is required for a review and compilation. This one is a trick. Independence is required for a review. Because I'm providing assurance, I must be independent. But independence is not required for a compilation. I can perform a compilation even if I'm not independent, as long as I clearly disclose my lack of independence in the compilation report. In fact, SASR's 21 requires that disclosure if independence is impaired or if the CPA isn't independent at all. So this statement is false. So the correct answer is A, one only. One only. Now let's bring in a couple of incidental but relevant points from the latest standards. Preparation versus compilation. Since SASR's 21, we also have a preparation of financial statements service. That's even lower than a compilation. A preparation engagement doesn't require a report at all. I just prepare the financials and put "no assurance provided" at the bottom of each page. This is a common distractor on exams. Don't confuse preparation with compilation. Independence spectrum. Remember it this way. Audit equals independence required, high assurance. Review equals independence required, limited assurance. Compilation, independence not required, no assurance, but disclosure if independence is impaired. Preparation, independence not required, no assurance, no report. Exam trap, they love to wordsmith around some assurance or negative assurance. A review provides negative assurance, meaning I'm not aware of misstatements. A compilation provides none. If you see the phrase provides some assurance, that is incorrect for compilations. It's review territory. So to wrap it in a way that sticks, audit is the full doctor's exam. Review is the quick checkup and blood pressure reading, some comfort but not full clearance. Compilation is just the nurse writing down your height and weight, no medical opinion given. Final answer? A, one only.
All right, let's really unpack this one. The setup: a senior manager on the audit engagement for an issuer leaves the audit firm and takes a job as the client's CFO. The question is, under SEC rules, what factor most directly affects the firm's independence? Option A is whether a one-year cooling-off period elapsed. Ding ding, this is the heart of the rule. The SEC says if anyone from the audit engagement team, not just the partner, but managers and even staff, goes straight into a financial reporting oversight role like CFO, controller, or equivalent, the audit firm's independence is blown. The only way to fix that? A one-year waiting period. So, if they left the firm in June 2024 and became CFO in August 2024, independence is gone. But if they waited until July 2025, after that one-year gap, then independence is preserved. It's like the SEC saying, sure, you can date your old client, but only after a respectable amount of time has passed. Option B is whether the person had a CPA license. Nope, the SEC doesn't care if the new CFO has a CPA or a scuba diving license. What matters is the job they hold, a financial reporting oversight role, and the timing. Option C is whether the audit committee pre-approved the move. Cute idea, but no. Audit committees have a lot of power over the auditor, but they can't magically override SEC independence rules. That's like your mom saying you can skip school. Nice, but the principal still marks you absent. Option D is whether the individual gave up unpaid bonuses from the firm. Now, unpaid compensation from the audit firm can be a conflict if the person still has a financial tie back to the firm, but that's a separate issue. The independence problem here is triggered by the CFO role and the timing of the move, not by the bonus. So, while the bonus might add some seasoning, the main dish is still the cooling off rule. So, which factor most directly affects independence? It's all about that 1-year cooling off period.
No cooling off, no independence. Here's the way I remember it. Imagine the SEC like a strict parent. Your old firm is the X, your new job as CFO is the rebound. The SEC says you can't move from one to the other overnight. You gotta cool down, eat some ice cream, watch some Netflix, and wait a full year before we're okay with it. Until then, independence is officially impaired. Final answer? A. Whether a 1-year cooling off period elapsed before the individual became CFO. All right, let's stretch this out and cover all the angles, because acts discreditable is one of those CPA exam hotspots where they love to test whether you know the code's specific no-nos versus the gray areas. The question says, which statement is true about acts discreditable? Let's go line by line. Statement 1. Retaining client records to force payment. The AICPA Code of Professional Conduct explicitly lists this as an act discreditable. Why? Because client records belong to the client, not the CPA. If I withhold them just because I want to collect my fee, I'm essentially holding their business hostage. The client can't file taxes, can't finish reports, can't satisfy regulators. The code says that's discreditable behavior. It damages the public's trust in the profession. So this one is definitely true. Statement 2. Discrimination or harassment in employment practices. Yes, this one also counts. The AICPA has made it clear that harassment or discrimination in hiring, promotion, or treatment of staff reflects poorly on the profession as a whole. So if a CPA firm has discriminatory practices, it's not just a legal issue, it's an ethical one too. The profession's credibility takes a hit, which is why the code includes this under acts discreditable. Statement 3. Failure to file a personal tax return on time cannot be an act discreditable if no tax is due. This is where the examiners try to trick you. The code is clear. Not filing your own tax return on time is discreditable regardless of whether you owe money. The issue isn't just the payment of taxes, it's the failure to comply with the law. Imagine me telling my tax client, hey, don't worry about deadlines. I didn't file my return either. That would shred the credibility of the profession. So this statement is false. So putting this together, statements 1 and 2 are true, statement 3 is false. That makes the correct answer C, both 1 and 2. Now let's connect this to exam strategy.
On the CPA exam, acts discreditable questions often hinge on specific listed examples in the AICPA code. Here are a few worth remembering. Holding on to client records to force payment? Always discreditable. Discrimination or harassment? Discreditable. Failing to file personal tax returns or paying your own taxes late? Discreditable, even if nothing is owed. Improper disclosure of CPA exam questions or cheating? Discreditable. Negligence in preparing financial statements or records? Discreditable. Disclosure of confidential client information without consent, unless required by law? Discreditable. The exam trap is usually a statement that tries to soften one of these, like not discreditable if no tax due, or allowed if the client hasn't paid yet. Those are red flags. And here's the way I like to phrase it. Act discreditable are basically the don't make the profession look bad list. If it smells shady or embarrassing, chances are it's discreditable. Holding records hostage? That's like a ransom note. Discrimination? That makes the whole profession look bad. Not filing your own taxes? That's like a doctor who smokes 2 packs a day. Technically possible, but not a great look for credibility. Final answer? C, both 1 and 2.
All right, let's expand this one out fully, because SEC independence rules are a favorite testing ground, especially when it comes to what auditors can and cannot do for public company clients. The question is, on SEC prohibited non-audit services to issuer audit clients. 1. Internal audit outsourcing services are prohibited. 2. Designing and implementing financial information systems is prohibited.
3. Tax return preparation is prohibited. Starting with Statement 1, internal audit outsourcing. This is definitely prohibited under SEC and PCAOB independence rules. Why? Because if I, as the external auditor, take over internal audit, I'd be evaluating my own work during the audit. That creates a self-review threat. It's the same as grading your own exam. No objectivity. So Statement 1 is correct. Statement 2, designing and implementing financial information systems, also prohibited. If I build or implement the system, then later I'm auditing the system's outputs, I'm basically double dipping. First as the builder, then as the watchdog. That's another self-review problem. Independence goes out the window, so Statement 2 is correct. Statement 3, tax return preparation. This is where the trap lies. The examiners want you to instinctively lump tax into the prohibited list. But under SEC rules, tax return preparation is generally permitted for audit clients, provided two conditions are met. It must be pre-approved by the audit committee, and it must not cross the line into aggressive tax avoidance or advocacy. So the blanket claim, tax return preparation is prohibited, is false. So the only true ones are 1 and 2. That means the correct answer is A, 1 and 2 only. Here's the bigger picture the exam is really testing. Think of non-audit services under SEC rules as falling into 3 buckets. Flat out prohibited. Anything that makes me audit my own work or take over management's role.
That includes internal audit outsourcing, financial information system design and implementation, bookkeeping, management decisions, valuation services, and legal or expert services unrelated to the audit. Allowed with restrictions, tax return preparation, certain advisory services, but only if the audit committee pre-approves them and they don't create advocacy or self-review problems. Definitely okay, services that are clearly unrelated to the audit and don't impair independence, but in practice, most are still pre-approved by the audit committee. And here's the exam strategy tip. When you see internal audit outsourcing or system design/implementation, your brain should immediately scream prohibited. When you see tax return preparation, pause. Don't fall for the trap. The exam loves to sneak that in, but it's only prohibited in extreme cases. To make it stick, picture 3 auditor hats. If I wear the internal auditor's hat, I can't also wear the external auditor's hat. Conflict. If I wear the IT designer's hat, I can't then audit my own system. Conflict. But if I wear the tax preparer's hat, I can still audit, as long as I don't get into shady, overly aggressive strategies and I clear it with the audit committee. Final answer? A, 1 and 2 only.
Okay, let's go through this. The question is, an audit manager is concerned about anchoring bias during allowance for credit loss testing. Which procedure best counters the bias? A, start with prior year allowance and adjust slightly for current data. B, develop an independent expectation from current data before reviewing management's estimate. C, adopt management's mid-range estimate if reasonable to save time. D, use a rule that any variance under 5% is immaterial and accept it. Anchoring bias happens when I lock on to an initial number, like last year's allowance or management's estimate, and then adjust too little, even when current evidence suggests a bigger change. It's basically getting anchored on the first number I see. Choice A, start with prior year and adjust slightly. That's the textbook example of anchoring bias, not the solution. If I only tweak last year's number, I may ignore real changes in credit risk, so this actually reinforces the bias. Choice B, develop an independent expectation from current data before reviewing management's estimate. This is the best way to fight anchoring. By building my own estimate from scratch, using aging schedules, current loss trends, and economic data, I'm not anchored to management's number or last year's figure. I come in with a fresh, unbiased perspective. Choice C, adopt management's mid-range estimate if reasonable to save time. That's basically surrendering to management's anchor. If I just accept their middle pick, I've given up independence. Bias lives on. Choice D, use a rule that anything under 5% is immaterial and accepted. That's not addressing anchoring at all. That's just applying a materiality shortcut. The problem is still there if the anchor is way off. So, the procedure that truly counters anchoring bias is B. Develop an independent expectation from current data before reviewing management's estimate. Think of it like shopping for a used car. If the seller says, "This car is worth $10,000, and I start my negotiation from there, I'm anchored, even if the real value is $7,000. But if I do my own research first and know the fair value is $7,000, I'm immune to their anchor." Final answer. B. Develop an independent expectation from current data before reviewing management's estimate.